download it or print it.
Okay, no problem.
Right, but everything will be shared. So yeah, that is the other thing. No need to just keep on writing. Anything you feel like write, you are free to write, but then do not waste your energies on writing. Let us spend all our energies on understanding the concepts.
Okay. Okay, one administrative thing, I have made the payment.
Right.
So tell your people that the payment has been sent.
Oh, that is why, Mr. Diga, you have received this invite. Okay. So we are very greedy people. Without payment, we will not do anything.
No, without giving
Okay.
Guru Dakshina, if we learn something, that will not help us, sir.
That is also very true. Very true. You see, this is what when an experienced person is there on the other side, you have good learnings. And I look forward to learn from all of you, because all of you are from different fields. That is very exciting for me also. Mr. Adiga has a huge corporate experience, and Mr. Rao is from Air Force. I have earlier also trained people from forces, right? They are really a gem of people to work with. And Dr. Thirumal is a known person. He's a doctor, right?
Yeah,
so I would be very happy to enjoy your company for 2 days.
My pleasure, sir.
Right. So just a quick primer. This has nothing to do with options. Just to defreeze things, right? So few things are important in this rule of 72. Most of us know this, that if I have a compound rate of interest as 9%, divided by 72, in 8 years, my money will double. If the compound rate of interest is, let us say, 10%, in 7.2 years, my money will double. Or if the rate of interest is 10% per month, then in 72 divided by 10, then in 7.2 months, the money will double. This is the rule of 72. Similarly, rule of 114 and rule of 144, corollaries of this rule of 72. In how much period my money will triple? If you divide the compound rate of interest by 114, it will tell you in how much period it will triple, and in how much period it will become 4 times if you divide it by 144. And only thing to be noted is we are talking about compound interest, not about simple interest. Simple interest is compound interest is we are getting interest on the interest earned also.
Yeah, understood.
And how much money, I like this rule, how much money you should invest in stock markets, 100 minus your age, right? If I am 40 years old, I can invest 60% of my surplus capital. Surplus capital means whatever I want to invest, not that 60% of my overall assets. Right?
Okay.
And even if your fund is invested in, let us say, a mutual fund, you should count that also as part of stock market investment. Right? Mutual funds are also equally risky. So it should not happen that, okay, 60% I am directly applying into stock markets and 40% is in mutual funds. That is not desirable at all. Right? And 4% withdrawal rule, okay, this you can read at a later stage, nothing very interesting. Do you consider yourself wealthy? I think this part I have already discussed with at least with Mr. Adiga and Mr. Rao. Doctor, I don't know whether I've discussed. So age, whatever is our age, multiply by pre-tax income. Let us say pre-tax income is 10 lakhs and age is 30 years. So 30 into 10 lakhs is 3 crores. Again, divide by 10, it becomes 30 lakhs. If your age into pre-tax income divided by 10 is equal to your net worth, which most probably will be, right? Then you can consider yourself to be wealthy. So no need to be stressed out. You are already pretty wealthy. Right? And I know the kind of fees we charge, only wealthy people join our workshops.
Those who desire to be wealthy, sir.
No, who are already wealthy. Only they join our workshop. and they want to remain wealthy, right?
Yeah.
We can add on that.
Yeah, there is only one question I have. This is loaded against the older people. Let's assume a person who is at 55 and is earning, let's say, 50 lakhs a year. So 55 into 50 is 200. you know,
Yeah.
about 25 crores.
Yeah.
Uh, in fact, yeah, 25 crores divided by 22.5 crores. But as you
Yeah.
grow old, you know, because of less life expectation,
Hmm.
wealth may not be that high, right?
No, it's other way around. No? If you are a very young guy, you have worked only for 2 years, your savings are not much, right? If you are a person who is, let us say, getting 50 lakh rupees a month, in any case, you need not check any barometer, right? You are already wealthy.
Hmm.
So, but with every
Pre-tax
year,
income
you keep on.
annually per month when you mention pre-tax income
No, no, I'm talking about pre-tax income per year,
per year. Okay.
right? So, as you grow, obviously your savings grow, right? We Indians are very good in savings, right? And we are very prone to savings. So, I think we are the highest saving percentage kind of people all around the world.
Yeah.
So,
That is
as you grow, obviously your income grows, but then your net worth also keeps on adding, right?
okay. Got it.
Yeah. Okay, let us start with the options workshop. Options are part of derivatives market, right? And derivatives are something which do not have any meaning of their own. They derive their meaning from something, and that something is known as underlying asset. They are derived products, derived from, obviously, if something is a derived product, it will be derived from something, right? That base is known as underlying asset. So if I'm talking about equity derivatives, the underlying is equity. If I'm talking about debt derivatives, which are not there in India much, so all these instruments, bonds, notes, these will be the underlying assets. If you're talking about index derivative, index will be the underlying asset. If I'm talking about currency derivatives, currency will be the underlying asset, right? And let me give you an example. Suppose I'm talking about future of Infosys. So in this case, underlying is Infosys, and spot value of Infosys will be the value of underlying. Is it clear?
Yeah.
Yeah.
We are conversant with these things, very basic, right?
Yeah.
So any underlying which is having its derivatives, like Infosys is a product which is having its derivatives. So there will be a spot price, there will be a future price, and then there will be different options, right? So options will have different price, future will generally have a slight premium compared to the spot price. So future is a derivative product of the spot of Infosys. Similarly, suppose I am talking about call of Reliance. So in this case, the underlying is spot of Reliance. I'm talking about, let's say, put of Nifty. So underlying in this case is Nifty. If I'm talking about future of Bank Nifty, underlying in this case is spot of Bank Nifty. Suppose I'm talking about uh, future of Sun Pharma. What will be the underlying?
Confirm.
Confirm.
Sun Pharma spot will be the underlying, right? So there are two kinds of instruments, futures and options in derivative markets. So if you divide the whole market into two parts, one is the cash segment where you can buy and sell shares, and other is the derivative segment. Under derivative segment, we have futures and options, and under options, we have call and put, right? Hence the term F&O is used. So two things are important. We must be knowing this. Futures and options, they are not traded as single unit. Like if you want to buy a share of Reliance, you can buy one share, you can buy two shares, you can buy 200 shares, you can buy 2 lakh shares, right? But in F&O, everything is traded in multiple of lot size. There is a lot which is fixed by exchange from October 2015, rather from November 2015. Exchange has said that, okay, minimum value of the lot should be 5 lakhs. So if a stock is priced at, let us say, 1,000 rupees, the minimum lot size will be 500. So 500 into 1,000, the value will become 5 lakh rupees. Right? I can give you an example that, okay, Reliance, the lot size was 250 and its price was 1,000 before November 2015. So the overall value of the lot was 250 multiplied by 1,000 was 2.5 lakhs only. But then with this rule coming in, they increased the lot size to 500. And after that, Reliance went up to as high as 1,600, 1,700, and then they have given a bonus. So now Reliance is again at 900, and the lot size is now 1,000. So the lot value of Reliance is 900 into 1000, 9 lakh rupees. Right? Am I making some sense, or it's clear? So that is how they decide that if, so they try to revise these things twice in a year in case a particular stock price goes down. Let us say, just for it's just a hypothetical example, I do not want Reliance to go down. Suppose Reliance goes to let us say 200 rupees. July, they will revise the lot size, change the lot size, and they will bring it to such a level that okay, the overall value of one lot is more than 5 lakhs. Right? So it will be 5 lakhs divided by 200, somewhere around 2500 or something of that sort will be the lot size. Right? And whatever is the lot size for future, the same will be the lot size for options. So if Nifty future is having a lot size of 75, all Nifty options will be of 75. You know any other lot size? What is the lot size of bank? 40. Right? Any other lot size, you know?
3750.
Which one, doctor?
Motherson Sumi.
Motherson Sumi. Okay. What is the lot size?
3750.
Oh, it's big lot size. Maybe the price is less, right? Price must be less than 200 rupees.
350.
350. Okay. Still the lot size is pretty big.
Yeah.
Okay. Another phenomenon which is not there in cash markets, there is a monthly expiry, right? Last Thursday of the month, all the contracts for current month cease to exist. So you can trade in current month, we can trade in second month, we can trade in third month. But what will happen on the last Thursday of the month? Only the current month trades will expire. Like this time, last Thursday of the month is 30th of November. So on 30th of November, now we can trade in November trades, we can trade in December trades, we can trade in January trades. But on 30th of November, nothing will happen to December and January trades, but November trades will cease to exist. We know this, right?
Yeah.
Okay. Let us try to understand what do we mean by options, right? There are two kinds of options. One is known as call option and one is known as put option. What is our understanding? What is a call option?
Option is a choice, choice to buy the right to buy or sell, and there will be choice to execute or not to execute.
Okay, that's fairly close to the real thing. Okay, Mr. Adiga, any understanding of what exactly do we mean by an option? By a call, sorry.
By a call is right to buy, not an obligation.
Great. Right. So it's a right, not an obligation. Let us see how it works, right? The definition is perfectly all right. I have taken an example from real estate because we understand real estate transactions very easily. So it is very close to a option transaction, although it may not be reflecting 100% of things as an option. Let me suppose I'm talking about a call option now. You can see this cursor, right?
Yeah,
Yes,
we
sir.
can.
Yeah.
You can see. Great. So let us say there is a person known as Mr. A, right? And let me assume today is 1st January, right? Mr. A wants to buy a house. So on 1st January, Mr. A goes to a builder and gave rupees 1 lakh to the builder. With this, what he has done, he has booked a house worth rupees 50 lakhs, and he says, I will be coming 3 months from now, and I will make the payment of 50 lakh rupees and I will take the house. A very normal transaction. He has just given a token money and he has booked the house, and 3 months from now, he will come and take the house. Right?
Correct.
Simple transaction.
Yeah.
Right? And this kind of transaction is a futuristic transaction. This transaction is not getting completed on 1st January. This is getting completed on 30th March, 3 months from now. So this is known as a forward transaction or a future transaction. right? Which will be getting completed in a future date. Now, what is the issue in this kind of a transaction? Now, on 30th of March, something happens in that area, something political or something geographical, and the value of the house becomes 30 lakhs only. This is just an hypothetical example, right? On 30th of March, the worth of that house is only 30 lakhs, which was 50 lakhs on 1st January. And Mr. A has already paid 1 lakh rupees to the builder. Now, what will Mr. A do?
He will leave that 1 lakh.
One of the options with Mr. A is leave that 1 lakh and maybe buy a similar house in 30 lakhs.
Okay. Yeah.
Correct.
Right. Other option is he goes by his commitment and pay 50 lakhs to the builder and buy that house. These are the two options. So financially wise decision will be let that 1 lakh be foregone and buy a similar house in 30 lakhs. It will cost him 31 lakhs. At least he's saving 19 lakh rupees in that. Right.
Correct.
If he wants to buy it in 50 lakhs, builder will be very happy to do that. But then obviously we assume that, okay, everybody takes a financially wise decision and Mr. A will not do that. Right. One option is he pays the entire amount, buy the house, which he may not do. Other option is he may let his 1 lakh be foregone and buy a similar house with 30 lakhs. Now there can be another scenario that on 30th of March, the value of house is 70 lakhs. What will now Mr. A do?
You would like to pay the 49 lakhs and buy it.
Now the price of house is 70 lakhs. Now he has to pay that 50 lakhs and buy the house.
Yeah.
And builder cannot say no. Builder cannot say no, or builder cannot demand 70 lakhs because Mr. A has booked the house in 50 lakhs.
Okay.
So that means Mr. A will be making a profit of roughly around 19 to 20 lakh rupees. So he will definitely come running and buy the house.
Yeah.
Right. And builder cannot say no. Builder has also not made a loss, but yes, he has got his profit reduced. He could have sold this thing in 70 lakhs, but he's selling it in 50 lakhs only now. Right. But with this, now builder is having a problem. He's saying, boss, this is a very, very unfair agreement with me. If the property value goes up, you say, okay, give this property to me in 50 lakhs. Suppose the property value becomes 2 crores. Mr. A will say, give this property to me in 50 lakhs as per the agreement. But if the property value goes down, let us say the property value becomes 20 lakhs, Mr. A just give me 1 lakh rupees and I lose 30 lakh rupees. So I can lose even 50 lakhs, but I cannot make anything extra if the property value goes up. So this kind of agreement is not fair to me. So my question to all of you is this a fair agreement to the builder or it's not a fair agreement?
It's a fair agreement.
It's a fair agreement. Doctor?
It
It's a fair agreement.
depends on the cost value of the builder.
Let us say cost value of the builder is 45 lakhs.
Then it is not a fair.
Then it is not a fair. You see, let us know. Fair and unfair, we will decide. You see, what happens is that there is a gap of 90 days. There is a free time available within which overall circumstances can change. Right. Now, in this case, what is happening is any increase in the price of property, everything is going into pocket of Mr. A, nothing is coming to builder.
Correct.
And in case of a reduction in price, everything is going from builder's pocket and nothing is coming to builder at all. Mr. A, in any case, will lose maximum 1 lakh rupees. So this is a kind of agreement for which is tilted towards Mr. A, wherein he can lose 1 lakh rupees, but he can make even 2 crore rupees out of that. But it is not in favor of builder who can lose 49 lakhs, but he cannot increase his profit at all. So that is why on surface, many times it looks, okay, this is not a fair kind of an agreement to a builder. I'm not talking about to a buyer. To a builder, this kind of agreement may look like to be unfair because this looks like a one-sided agreement. Right or wrong?
Right.
Reality, because he needs to take 1 lakh or whatever it is, he is making an assumption on the market remaining flat or going down, so that 1 lakh will become a this thing. If he felt, market is likely to go up, instead of 1 lakh, he may ask for 10 lakhs or 20 lakhs.
No, let us say you are very right. Since he is into business, he might be knowing that, okay, what will happen. But you see, many times there are certain things which are not in our control.
Yeah.
You never know. Like I remember there was a movie released by this Farhan Akhtar, and the day the movie was released, the very next day, demonetization was announced by government.
Mm.
So the movie, which was bound to make maybe 100 crores, failed to make even 10 crores, right? Without any fault of the makers of the movie. So there are many times external things which are not in your control. So the property value can go down also without any fault of builder. There can be a geographical reason, like there is a flood, there is an earthquake, something like that,
Yeah.
right? So that way, he is going to lose a huge amount on that property, but Mr. A is pretty much safe. Let us not go into discussions of property. Let me show you how it is fair or unfair.
Yeah. Sure.
Now, who has paid money? Mr. A has paid money to the builder, right?
Correct.
So the person who is giving money is always a buyer. In any transaction, there is a person who is a buyer, there is a person who is a seller, right? So Mr. A has given money, so he is a buyer. But what has he purchased in that 1 lakh rupees? He has not purchased house 1 lakh rupees. He has intention to buy the house, but he has not purchased house in that 1 lakh rupees. In that 1 lakh rupees, he has just purchased a right. He has purchased a right to buy the house in 50 lakh rupees, just so that the price, if any increase in price is not adversely affecting him. By paying 1 lakh rupees, he has just purchased a right to buy the house. Not that he has purchased one bathroom of the house, right? Right to buy the house, right? And he has purchased the right to buy. Obviously, builder has sold that right to him. You see, in any transaction, if there is a buyer, obviously it has to be somebody who is a seller. Otherwise, the transaction will not get completed. So Mr. A has just purchased a right to buy the house. If that right to buy the house is beneficial to him, he will go ahead and complete that purchase. If that right to buy is not beneficial to him, suppose the property value becomes 45 lakhs, he will not go ahead. He will say, okay, let me forego this 1 lakh rupees, right? But if the property value is even 52 lakhs, he will say, let me take benefit of that 2 lakh rupees, whatever extra is there, right? And builder has given this right to Mr. A by accepting that 1 lakh rupees, and he knows all the consequences. In spite of that, he has done this kind of an agreement. So that is why we say this kind of agreement is fair to builder also, because nothing is hidden from builder. If some things are hidden from builder, then he can say unfair or fair. But he knows all the consequences, that okay, if the property value falls, Mr. A will not come back. I will get only 1 lakh rupees. If the property value goes up, Mr. A will ask for that property in 50 lakh rupees. Right? So he knows all the outcomes of this transaction. So nothing is hidden to him. So everything is fair in this kind of a transaction. Right? And secondly, nowhere it is said that okay, builder was owning any property. He may not be having any property at all. What he can say that okay, at the end of the period, let us say on 30th of March, if the property value in the market is 55 lakhs, he will say, Mr. Take this 5 lakhs from me. In any case, I'm going to contribute 50 lakhs and buy that property. I am not having any property. And other thing is not having any property. He has taken 1 lakh from Mr. A, and property value is 45 lakhs. Mr. A will never come back. So he makes 1 lakh rupees. Right? He can, since he is into this business, he knows that property value is going to go down. He can, without owning a single property, he can do such an agreement with 10 other people. Everybody will pay him 1 lakh rupees. At the end of the tenure, nobody will come back, and he still makes 10 lakh rupees without giving anything to anybody.
Okay.
Right? So this is all speculative trading. It doesn't mean if you're buying or selling anything, or if you're buying or selling a right of anything, that doesn't mean you are owning that property or that underlying asset. Even if you're not a owner of underlying asset, you can still trade. Right?
Okay.
So without having any stock of Reliance, you can still sell 10 lots of Reliance. Without having single share of Nifty, you can still sell 100 lots of Nifty. Right? If the rate is favorable, you will make money. If the rate is not favorable, you will lose money. Right? So this is a call option. What is a call option? A call option is an option granting the right to the buyer of the option to buy the asset on a specific day at an agreed upon price. Now, in our case, who was the buyer? Mr. A was the buyer. And what underlying asset he was trying to purchase?
Home.
That house, right? And specific day, 30th March was the last day up to which this agreement is valid. After that, it is not valid at all. Right? So 30th of March was expiry day for this agreement. At an agreed upon price was 50 lakhs. This was the strike price. Right?
Correct.
And there was a seller who has granted the right to the buyer of the option. So this is known as a call option. So any call option will have an underlying asset. It will say whether it belongs to Nifty, Bank Nifty, Reliance, Infosys, HDFC, whatever. It will have a specific expiry day that, okay, Indian markets, last Thursday of the month is the expiry day. And it will have a strike price also. Hope you are clear with the concept of strike price.
Yeah.
Right? And then it will have a price also. In this case, the premium was 1 lakh rupees. That was the price of the call. Right? Is it clear? Any questions?
Clear.
Clear.
Clear, right? Great. So let us quickly understand what is a put option also. Put option is a reverse of call option. It is known as right to sell. Right? Let us say the same situation, there is somebody known as Mr. A. Today is 1st January and Mr. A is interested in buying a house. So this time, builder goes to Mr. A on 1st January and gave 1 lakh rupees to Mr. A. This doesn't happen in real markets, right? But then stock market need to give you all possible logical transactions to complete the market. Have you seen any builder coming to us and saying, okay, take this money and then you will buy my house? This doesn't happen as of now, right?
No.
Now, by paying this 1 lakh rupees to Mr. A, what has builder done? He has taken a commitment that Mr. A will buy the house at rupees 50 lakhs on 30th March by making the payment. He has taken a commitment from Mr. A that Mr. A, you can keep this 1 lakh rupees right now and you will come to me on 30th March, that is 90 days from now, and pay me 50 lakh rupees and buy this house. And Mr. A says, okay, give me this 1 lakh rupees. He accepts that 1 lakh rupees. Right now, what is happening? Let us see in this situation. Who is the buyer of the house? As far as house is concerned, Mr. A is the buyer, right? Who has given money?
Builder.
Fine.
Builder has given money to Mr. A. So by giving money, whenever you pay something, obviously you buy something for that. So what has Mr. Builder purchased? Mr. Builder has purchased a right, right? He's the buyer of the right. He has purchased a right to sell the property to Mr. A at 50 lakhs. He has purchased a right to sell. By giving that 1 lakh rupees, he has purchased a right to sell the property at 50 lakhs to Mr. A. Now, suppose on 30th of March, the value of property is 70 lakhs. What will happen?
Mr. A will buy the house. by paying 50 lakhs.
No. Who will call the shots? The person who has made the payment will decide what to do. Builder will say, Mr. A, I am not going to sell this property to you because you are going to pay me 50 lakhs. Keep that 1 lakh with you. I am going to sell this property to somebody who is giving me 70 lakhs.
Okay, sorry.
Builder will decide, right? Because builder has made the initial investment. But suppose the property value becomes 25 lakhs. What will happen in that case?
Then builder will force
A to buy it.
Exactly. Then builder will say, Mr. A, you have to pay me 50 lakhs because that is our agreement. So what builder has done? He has ensured that his property will go at least in 50 lakhs.
Yeah, right.
Even if the value of property is 4 lakhs, he has purchased a right to sell the property in 50 lakhs. Mr. A has to give 50 lakhs. Right? So that is the purpose of right to sell. Right to sell means by making some small investment right now, I have ensured that I will be getting at least that 50 lakh rupees on my property. In case the property value becomes 90 lakhs, I can very well say, okay, Mr. A, you keep that 1 lakh rupees from my side as a gift, and I am going to sell this property to a person who is giving me 90 lakh rupees. So it doesn't cap my profit on upside, but it definitely caps my loss if anything is possible on that side. Right? So this is a difference between put and call. This is a right to sell. Call is a right to buy.
Right.
Right? And A has sold that right. Now, if somebody is accepting some money, obviously he is giving some goods or services or anything. So A has given that right to Mr. Builder. By accepting that 1 lakh rupees, A is insuring his property in 50 lakh rupees. Builder may or may not exercise the right. Same thing, worth of house, suppose it is 30 lakhs on 30th March. Builder will exercise his right. He will say, Mr. A, give me 50 lakh rupees. A has to pay 50 lakh rupees and buy the house. And there will be loss of 19 lakhs to A. Builder saves that money. And in case the price of the house becomes 70 lakhs, builder will not use his right. A will keep 1 lakh with him and builder makes an additional profit of 19 lakhs. So what is a put option? A put option is an option granting the right to the buyer of the option to sell the underlying asset. It's a right to sell. Right? And there is an expiry day, there is a strike price, there is an agreed upon price. Is it clear?
Yep.
Yes.
Any questions?
No, sir.
No questions? Okay, great. So don't, you see, other thing is, I will try to confuse you by telling some right and wrong things, right? During these 2 days. Because I have studied at IIMs and there our professor used to say the purpose of my class is to confuse you. Right? Purpose of my class is confuse you because if you are confused, only then you will go back to notes and you will ask questions and then only some learning will take place. So my purpose is also to confuse you. Right? So it is onus is on you not to get confused and ask questions. And these whatever nonsense so far I have spoken, you see, this is just a physical meaning of call and put. Even if you have not understood 5% of whatever I'm talking, it is okay. That may not be very useful for trading purpose, but it's just for understanding purpose. Right? So do not put yourself under yourself into undue pressure that okay, any example we'll take, you start thinking, okay, what happened to the builder, what happened to Mr. A, and start connecting the dots from there. Not required at this stage. Automatically these things will sink in. Right?
Right.
Okay, there are 4 kinds of transactions in stock markets: FUT IDX, FUT STK, OPT IDX, OPT STK. Are you conversant with these 4?
Yeah.
Yes, sir.
All of you, Mr. Rao,
Yes, sir.
Doctor.
Yes.
Yeah, sir.
Okay, suppose I want to buy a call of Bank Nifty. What will I choose from here?
Future
Index.
Option index.
option index.
option index, right? We have two indexes, Nifty and Bank Nifty. So anything we want to do in those two, we need to choose index as one thing. If you want to buy future of that, we will choose future index, FUTIDX. And if you want to trade in call and put of Nifty and Bank Nifty, you will choose option index, OPTIDX. Similarly, if you want to trade in call and put of any stock, then what you will choose? You will choose OPTSTK,
Yeah.
option stock. That is the fourth option. After that, you will get a drop down, which stock, when call or put, and which month. All those things will come later. But first thing is you need to choose a uh, proper transaction, right? So if you want to trade in stock futures, you need to choose FUTSTK, right?
Right.
Any call put future can be sold or purchased, and it can be kept like that till expiry. Expiry is last Thursday of the month. So if you have purchased a call, you are free to keep it till the expiry day. On expiry day, if you do not square it off, exchange will automatically square it off at 3:30 last Thursday, and whatever is the profit or loss, that will be booked in your account.
Okay.
You have a choice. You can buy or sell a call, and you can close the position 2 minutes after that. That is your choice. But maximum you can keep it till expiry day. So if you have done any transaction in December, so you can keep it till 26th of December. But after 26th December at 3:30, it will get closed by the exchange, and profit and loss will be settled in your account. Right?
Got it.
Okay, since you are not asking, let me ask you some questions. And I want individual replies, please, right? So what happens to call rates if market goes up?
It goes up.
Call rates will increase.
Right, doctor? Call rates will go up. Call rates are generally directly proportional to the direction of market. And put rates are inversely proportional to the direction of market. If market goes up, put rates will go down. If market goes down, put rates will go up. Clear?
Yeah.
Yes.
Okay, let us ask an out of syllabus question. What is the premium in call if market is at 8200 and 8300 call is available at rupees 75?
$8,200 divided by 8,300 into 75.
Oh, that is very complex. What is it? Come again, Mr. Adiga?
I mean, I don't know the answer. I thought it will be 8,200 divided by 8,300 multiplied by 75.
That will be very complex, actually. Good
It
answer.
will be
Very good logic. Yeah. Yeah, Mr. Rao, what is the answer?
It will be IIM.
Sir, please show me once again. The question is not clear.
Question is not visible, is it?
What is the premium in call if market is 8200 and if the call is available at 75?
So let me explain the question again. Market means Nifty. This is a Nifty call, right? 8300 call. Nifty spot is at 8200. And when spot is at 8200, we have 8300 call, 8400 call, 8500 call, like that, right?
Right, sir.
8300 strike price call is trading at rupees 75. My question is, what is the premium in this call?
75 is the premium, sir. For 8200 call, there will be zero premium, sir.
For a call, what is the premium? 75. This is asking premium in which call? 8300 call.
Call is available at 75.
Premium is 75, sir.
It is 75. Exactly, right? If it is available at 75, premium is 75. So generally, premium and price, these two terms are used synonymously. Right? 8300 call, if it is trading at 75, the premium is 75. That's it.
Yeah, that's it.
right? If market is less than that call, obviously whatever is the price, everything is premium. I will show you in the next slides what is in the money, out of the money, right? From there,
can you just help me with this? And so if the market is at 8200 and 83 call is at 75, yeah, okay, I agree. It's 75 only.
it is 75.
Yeah, okay, I got it. Yeah.
Right.
Thanks, doctor.
Okay, very simple. What is the lot size in Nifty? We all know.
75.
75.
75. Okay, what do we mean by a long call?
Buyer of the call.
Okay, you see, in stock markets, this is a very common terminology. If you are long in call, means you are buyer of a call. If you are long in stock, means you are a buyer of the stock. If you are long in future, means you are buyer of the future. So long is used as a buyer. If you are long in put, means you are buyer of the put. Right? Similarly, what do you mean by short call? Means you are a seller of the call. So whether you are buyer or seller, ultimately you need to square it off. If you are a buyer, you need to sell it before expiry, or automatically exchange will do that. You are a seller, you need to buy it. Once the transaction is complete, then you will come to know what is your profit and loss. Profit, simple equation of profit means selling price minus buying price. If selling price is more than buying price, it is profit. If selling price is less than buying price, it's loss. Am I clear?
Yeah.
Yes, sir.
Yeah.
So people who short options are known as option writers also. They short options basically to buy them at a lower rate at a later stage. Right? That doesn't mean people who short option, they just short it and then they need not buy. Ultimately, they have to close the transaction. Options are traded at different.
Strike prices.
Exactly. Right, Mr. Rao, Mr. Adiga,
Yes, sir.
Mr. Dr. Thermal, right? Options are traded at different strike prices, and if you are aware of the concept of strike prices, that will be really helpful.
Yeah.
Okay. Let me explain you quickly what is in the money, at the money, and out of the money. Right? And you know this, most of the concepts. I am talking about calls only as of now. Right? Let us say market is at 7,500. Market means in this case, because I'm taken underlying as Nifty, so let us say Nifty spot is 7,500, and the difference between different strikes of Nifty are 50-50. 50 points difference is there. So there will be a call of 7,500. There will be a call of 7,550. There will be a call of 7,600. There will be a call of 7,650. Similarly, 74, 7,350 and all, right? So
Sir.
any now in the money, at the money, out of the money concept is used for strike prices, not for market. Market is always at the money, right?
Right.
This concept is used for strike prices. I will request one thing. I am hearing my own voice through your systems. So if you can mute your mic. Whenever you have a question, you can unmute it and ask me a question.
Okay.
Because others also must be getting that noise. I don't know.
Can you hear me?
I can hear you right now.
Okay. Muting.
Right? So if it is muted, so others will not get the noise. As and when you have a question, unmute it and ask me a question. Right? So 7,500, if market is at 7,500, 7,500 is 7,500 call will be known as at the money. Is exactly same as that of market. And any call which is above 7,500 will be out of the money. 7,550 is more than 7,500, it is out of the money. 76 is more than 7,500, it is out of the money. And any call which is below market, that is 7,500 below is 7,450, 7,400, 7,350. This is known as in the money.
So when you say in the money, just to be very clear, That
Yeah.
means somebody bought an option at 73.50, at 7,500 is in the money, right?
Exactly.
And if the market is at 76, I mean, if you bought an option at 76.50 and the market is at 7,500, he's out of money.
That is an out of the money option.
Okay.
In the money, out of the money gives you the relationship between the strike price and the spot of the market. Now, let me ask you a question. I said market is 7,500, 7,500 is at the money. Suppose in half an hour, market becomes 75.20. So what will be at the money?
75.20.
7,500 only. Till 7,500 at the money.
7,500, sir.
Come again.
Till 75.50 or 74.50, you are at the money. Only when you go to 74.50 or 75.50, it changes.
Okay, that is one understanding. I think Mr. Rao, you were saying something? Or doctor, you were saying something?
Yeah, sir. If it goes to 7520, then 7500 is at the money only, sir. In the money.
75 exactly. If it goes to 7520, 7500 is in the money by 20 points.
Yeah.
Nothing is at the money.
Mm.
Not required that at the money something is available, right? So if you see conceptually, nothing is at the money if market is at 7520. But practically, we say the nearest call is at the money. So if market is 7520, we say 7500 is at the money. But if market is at 7540, so practically you will say 7550 is at the money.
Correct.
But conceptually, nothing is at the money. Right?
If it exactly at 7500, then it is at the money.
Then it is at the money. Right? So if suppose market goes to 7360, so anything which is above 7360 is out of the money, and anything which is below 7360 is in the money.
Correct.
Yes, sir.
Right? So 7350, even 6900, everything is in the money. Suppose market goes to 7620. So anything above 7620 will be out of the money, and anything below 7620 will be in the money.
Correct.
Right? And only option strike prices are in the money or out of the money. Market is never in the money or out of the money.
Okay, how do you use this? Where does this? Where is the? How it is used in the conversation? Like, what is the?
What is the utility? Question is, what is the utility of this? Right? What is the significance of this?
Yeah.
I'm coming to that. That is the next logical question, right? But first, we should know what is in the money, what is out of the money. This is a very clear. You can see the market. Wherever is the market, you will immediately know what is in the money, what is out of the money. Right? Now we will come to know what is the significance of ITM or OTM or ATM. Let us say I have taken an example that market is at 7500, and this is the beginning of the series. Series means a monthly series. That let us say this is the first day of the month, and a new series has started. Market is at 7500, and I have taken 5 different options: 7400, 7450, 7500, 7550, and 7600. Right? Which of the options are out of the money?
Out of the money. 7550 and
7550 and above.
Above. Yeah.
7550 and 7600. These two options are out of the money. This 7550 is priced at 40 rupees. 7600 is priced at 20 rupees. What is 7500?
At the money.
In the money.
At the money.
This is ATM at the money, and it priced at 70 rupees. 7450 and 7400 are in the money, priced at 140 and 110. Right?
Okay.
Now, the money options will have 2 parts to its value. Now, this 140, it means options are decaying assets, right? They have some time value which keeps on decaying every day. Now, if I say market is at 7500, what is the difference between the market level and 7400?
That is 100. 100.
That is 100. So out of this 140, 100 is the intrinsic value and 40 is the time value. Right? 100 is the intrinsic value and 40 is the time value. In case of 7450, what will be the intrinsic value? The difference between these two.
50 plus
50 plus 60. Time value.
Yeah, 50 and 110 minus 50 is 60.
Yeah.
So 60 will be the time value. Right? For
Mm.
7500, what will be the intrinsic value?
0. Sir.
Intrinsic value will be 0.
0 plus
Everything is
70.
time value. Right. For 7550, all out of the money options have only time value, no intrinsic value is there. Because we do not trade in negative values, right? 7500 minus 7550 is minus 50. So there is no negative value. It is taken as 0. So 40 is the time value. And similarly, in 7600, 20 is time value only.
Right, sir.
Are we clear what is time value and what is intrinsic value? In the money options, we'll have both. Out of the money options and at the money options, we'll have only time value. Right? So as said, options are decaying assets. Let us say in the beginning of month, this was the scenario. And in the whole month, market has gone up and market has gone down to 7300, 7700, whatever has happened. And let us assume for easy understanding that the market has expired on last Thursday at 7500 only. Right? Let us say market has expired at 7500 only. Now something which has expired has no time left. So if no time is left, obviously there will be no time value. Right? So in case of 7400 call, there is no time left. So time value of 40 will become 0. And the final value of this call will become 100. In case of 7450, the 60 time value will become 0. The final value of this call will become 50.
Is it? Okay, I was under the impression on the expiry, there is no value for the call left.
Yeah, that is also true, but only for at the money calls or in the out of the money calls. Now at the money call 7500, there is only time value. And on expiry day, the value has eroded, right? So the final value is 0. For out of the money options, this 40 will become 0. Overall value will become 0. For 7600 also, it will be 0.
Okay.
So any option which is expiring out of the money or at the money, the value on expiry will be 0. And any option which is expiring in the money, the value will be its intrinsic value.
Okay.
Correct.
And intrinsic value is known as moneyness of the call, moneyness of the option, right? So suppose market expires at 7500, what will be the value of 7000 call?
7500, sir.
If market expires at 7500, what will be the value of 7000 call on expiry?
500.
500.
500, Mr. Adiga, we agree to this?
Yeah.
Exactly. So it will be 500. Suppose market expires at 7500, what will be the value of 7350 call?
150.
150.
150. If market expires at 7520, what will be the value of 7400 call?
120.
120.
120, right? If market expires at 7520, what will be the value of 7700 call?
0.
0.
0, right? It will be out of the money.
Yeah.
So you have understood it, right? You know this.
Yeah.
Any questions on this?
No.
No, sir.
No, but still my question is, how is it used in what is the objective of this? I mean,
Okay.
What is the significance of this? I understand this is you are in money out of the money, but I still not figure out how it is used, how it is relevant.
You see, options are basically decaying assets. So
Hmm.
options keep on losing their value every day. And
Okay.
what is the value that an option can lose? Suppose market is at 7,500 and in the beginning of the month, 7,000 call is at 600 rupees.
Hmm.
So you know that in case market remains here only, this call will lose only 100 rupees.
Okay.
So what is the decaying portion of a option that is given by ITM OTM concept?
Okay.
So suppose market is at 7,500, 8,000 call is available at 100 rupees. So you know if market doesn't touch 8,000, this 100 rupees is going to become zero,
Hmm.
right? So if I know that okay, this something which is worth 100 is going to become zero, obviously I will sell it and I will sell it at 100 and buy it at zero. So I make 7,500 rupees,
Hmm.
right? So that is how in the money out of the money concept tells you what is the premium available in a particular option. And it gives a relationship between the strike price and the spot. You can just see the strike price and the spot and you can tell okay whether it is in the money or out of the money or at the money, right? When we will be doing strategies, it will become more clear why this concept is very important. Although what we are talking is all very basic, all nursery pre-nursery stuff of options, but still we need to understand these things well, right? If we want to write an essay, obviously I should know all 26 alphabets pretty well, right? So these are all basic stuff, but still we need to be very clear in this mechanism,
Okay.
right?
Yeah, fine.
Okay, if this concept is clear to you, I will be doing some questions with you, and you need to answer these questions. Just focus on your answer. Do not get influenced by anybody else's answer, so that you know the concept. These 13, 14 questions will clarify the concept thoroughly, right? Let us to do these questions. CE is called European. In India, we follow European options, right? There are two kinds of options: European options and American options. And European options can be exercised only on expiry. So only for academic sake that you need to learn the difference. Otherwise, it's not at all useful. So all European CE means call. Call of Nifty 8500 was premium rupees 142 at the beginning of the month. On expiry, Nifty closed at 8400. What will be the value of this 8400 call on expiry?
Zero, sir.
Zero, sir.
Okay, Mr. Rao says zero, Mr. Doctor says zero, Mr. Adiga.
Premium
I don't know what is the correct answer.
zero. Yeah.
It's going to be zero, is it?
Yeah.
Why zero, Mr. Rao?
Sir, market is not gone up to the promised that up to that level, sir. That's why time value is decayed totally zeros, become zeros.
It's out of money.
If
Yes, sir.
market is at 8400, 85 is out of money or in the money, it is out of the money because it is above market, right?
It's out of the money.
Anything which is out of the money on expiry will become
Zero.
so the answer is zero, right?
Yeah.
Perfect. Let us see the second question. All of 8500 was 142 at the beginning of the month. On expiry, Nifty closed at 8500.
Zero,
Zero, sir.
zero.
What will be the value?
At the money.
Zero.
Exactly. At the money, things will also become
Zero.
zero. So the correct answer is zero. Whether it was 142 or 542 or whatever, it doesn't matter at all. On expiry, if it is at the money or out of the money, it will become zero. Okay, great. Let us do the third question. 85 was 142 at the beginning. On expiry, Nifty closed at 8600. What will be the value of this call on expiry?
100.
100, sir. 100.
Market is saying 8500 is in the money or out of the money?
42 rupees loss, sir.
In the money. In the money.
It is in the money. So value will be?
Profit will be 100.
Loss is 42, sir.
Loss is 42. But what will value of 8500 call?
100.
It is 100, sir. 100.
100, right? So value will be 100 rupees. But how can you say, Mr. Rao, will be a loss?
This one per.
Our selling price is less, buying price is less than selling price.
So buyer, ultimately it's a zero sum game. Some loss is somebody's profit. 90% will lose money, 10% make money equivalent to what 90% lose. So if somebody purchased at 142 and then ultimately it closed at 100, he will be losing 42 rupees. But this 40 rupees will be going somebody else's pocket. Somebody who sold at 142 and 300 will make that money. So you cannot say it is a loss. It is a profit also. Somebody it will profit, or somebody it will be loss. And loss and profit will always be equal. Right or not?
Sir, voice is not clear, sir.
Voice is not clear, all of you?
Yes, sir. It is cutting, sir.
Some disconnection. Now it is okay.
It's okay.
There can be internet issue on your side, on my side also. If it is cutting for all of us,
Now it is okay, sir. Now it is okay.
is it okay?
Now it is okay, sir.
Okay, maybe in between there can be some connectivity issue. So what I am saying is, loss and profit will always be there in equal quantity. So 40 rupees will be loss for somebody, but 42 rupees will be profit for somebody else. Right, Mr. Rao?
Yes, sir.
Okay, let us see this. All of Nifty 83 was purchased at rupees 70 at the beginning of the month. What is the profit loss if it expired at 8500?
200 minus
200
70.
minus 70, sir. 130 rupees profit.
Okay. With 8500 expiry, 8300 is?
In the money.
So its value will be 200, right? 85 minus 8. I have purchased it at 70. So my buying will be 20. So profit is 100.
Yeah.
Right? What is the minimum profit?
Minimum profit
Of lot size, sir, into multiplied by lot size.
Exactly. So just to make you conscious that okay, in options we are trading in multiples of lots. So it cannot be that one unit. Minimum in Nifty is 75. So minimum in case 130 profit is 130 into 75. It will be in multiples of 75. Right. So Mr. Rao has seen all the videos already. Right, Mr. Rao?
Straddle and Strangles video that I have seen, sir.
Okay, great. Fifth question. If 8300 was purchased at 70 at the start of the month, what is the profit loss if Nifty expired at 8300?
Loss of 70.
Loss of 70.
loss.
Exactly. So all of you are very clear on this. Let me not waste any time on this. So 70 rupees we spent, that became 0, and there is a loss of 70. Let's see this one. 83 was purchased at 70. What is the profit loss if Nifty expired at 83.70?
0 loss.
Profit 0, sir. Loss is also 0. No profit, no loss.
Yes, Mr. Adiga?
That's correct. No profit, no loss, because 70 rupees came, but the time value is 0. So it's overall nil.
So with 83.70 expiry, 8300 is in the money. That means 70 rupees will be the value. I purchased it at 70. I'm selling it at 70. So 0 profit, 0 loss, right?
That's correct.
Okay, 8300 was purchased at 70 at the beginning. What is the profit loss if Nifty expired at 8,000?
Loss of 70.
Yes, sir.
Correct, sir. Loss of
70
Loss,
loss.
70 loss, right? With
Correct.
8,000 expiry, 8,300 is out of the money, and everything out of the money will become zero. So 70 is the loss. So in this case, we can say my maximum loss in case of buying options is equivalent to buying price. Even if market goes to 5,000, I cannot lose more than this 70, right?
correct.
So my loss is limited when I am buying options.
Correct.
Let us see this one. 8,300 was purchased at 70 at the start of the month. What is the profit loss if Nifty expired at 9,000?
1630.
100 rupees.
1630.
630.
630,
630, sorry.
right? 9,000 minus 8,300 is 700. 700 will be my selling price, and I purchased it at 70. So 630 multiplied by 75 will be my profit.
Yeah.
So my profit can be anything. If I am buying options, my profit can be anything. If market goes to, let us say, 10,000, it will be 1630. If market goes to 20,000, it will be unlimited, right? So in buying options, my loss is limited to my buying price, but my profit can be unlimited. It can be anything. There is no cap on that. Is it clear?
Yes.
Clear.
Okay, let us see this one. Call of 8,700 was sold at rupees 59 at the start of the month. What is the profit loss in case Nifty expires at 8,700?
59.
59
59
profit.
Is the
Profit
profit
to
or
the
loss?
seller.
59?
Profit to the seller, sir.
Is the profit to the seller. We are a seller here. We said it was sold at 59, right?
So it's a profit of 59.
So 87, it will become at the money. It becomes, I sold it at 59. I will buy it back at 0, and hence the profit will be 59. Right?
Yes.
Next question. Call of 87 was sold at 59 at the start of the month. What is the profit loss in case Nifty expires at 8,500?
59.
I sold that market.
59, sir. 59 profits.
Okay. Let Mr. Adiga also calculate that.
So I sold that, the Nifty will be at 8,700 at 59,
Right.
and it expires at 8,500.
Hmm.
A bit confused on this.
So why my profit is not 259?
Because it was below, it should be 259.
It should be 259, right?
Okay, sir. It should be
It
That
is
is why I said do not get influenced by others' answers,
I know, exactly. That's why I got confused. It should be 259.
right?
Yeah.
Mr. Rao, is it 259? Okay.
259 should be there, sir, because he has sold at 59 and it has crossed already.
Okay, great. Doctor?
Sir, it is 59 only, sir. Because seller at the maximum he gets only premium.
So is it 259 or 59? Two people are saying 259.
I'm saying 259, sir.
Mr. Adiga, 259.
I sold it at 8,700. I will not get more than what I sold it for. Yeah, it's 59.
59.
You have changed your answer now, is it?
Yeah.
And Rao, you have gone from a right answer to a wrong answer. I have supported you in that.
Sir, in sold, the profit will be limited. That's why it may be 59 also, sir.
That's a very good answer. Okay, you see, we need to see the logic. 8,500 expiry, 8,700 will be out of the money,
Okay.
right? And I have sold at 59, so out of the money will become not minus 200, it will become 0. So I have sold at 59. I will be buying it back at 0. Many people confuse that, okay, I will get a 259 profit. After 8,700, even if market goes to 6,000, 8,700's call will become 0 only. So only thing I will be able to capture is the journey from 59 to 0. That's it.
So the profit will be 59 for the seller.
59 for the seller and loss will be 59 for the buyer. That's it.
That's correct, yeah.
Mr. Rao, is it clear?
Sir,
Clear?
59 profit.
Okay, let us see the next question. 87 was sold at 59 at the start of the month. What is the profit loss in case Nifty expires at 8,000?
59.
59 profit.
Correct.
Now is it clear whether it goes to 1,000 or 0? 59 is the maximum profit.
Yeah.
So when you are selling options, your profit is limited to selling price. So profit equation says sell price minus buying price. If buying price is 0, maximum profit can be selling price. Right?
Right.
In any transaction, not only in options, in any transaction, your maximum profit is equivalent to selling price. Suppose this water bottle I have sold in 200 rupees and I have stolen it from a hotel. My maximum profit cannot be more than 200.
Yeah.
Right? So it will be 200 rupees only. If I have purchased it from a dealer in 150 rupees, I have sold it in 200 rupees, my profit is 50 rupees.
Yeah.
But if I am selling it in 200 rupees and I have stolen it, the maximum profit cannot be 201 also, it will be 200 only. Right?
Okay.
Call of 8,700 was sold at 59 at the start of the month. What is the profit loss in case Nifty expires at 8,900?
Loss is 59.
Loss is more than 59, sir.
Okay, all of you first decide and give me the answer.
200 minus 59, 141 loss, sir.
No, I sold it at 59. If it expires at 8,900, I don't make any more money. That is the best.
141 loss, sir. 141.
Mr. Rao says 141 loss. Mr. Adiga says 59 loss. Doctor, you need to give the final verdict.
Yeah, 59 means totally 200 rupees, sir. 8,700 we have sold and it has reached to 8,900. So it will be 200 rupees, sir. Net 141 rupees we need to pay extra.
141 will be the
Extra we need to pay.
loss, right? That is the loss.
Yeah.
Okay, so when market expires at 89, 8,700 becomes in the money. It is below market, right? It is in the money. So in the money will become 89 minus 87, 200 rupees in value. I have sold it in 59 rupees. I need to buy it back in 200 rupees. So selling price 59 minus buying price 200 minus 141. So my loss will be 141 rupees.
Sir.
Mr. Adiga, you got it or not?
No, not till you'll have to repeat it.
At 8,900 expiry, what will happen to 87? First thing is we need to see whether it will expire in the money or out of the money. So we know from 8,900 expiry, 8,700 will be
In the money.
in the money. So what will be the value of this call?
200 minus 59.
Value is 200. I have sold, so I need to complete the transaction by buying it back at whatever rate it is available. It is available at 200.
Okay.
I have sold it at 59 and I will buy it back in 200 rupees.
141.
141 is my loss.
Yeah.
Right?
Yes.
Okay.
Let us see another example. See this one, what happens in this case. 8,700 was sold at 59. What is the profit loss in case Nifty expires at 9,000?
300.
241.
241.
241 is what? Profit or loss?
Loss.
No, it's a
Yes,
profit
Mr.
for the buyer, loss for the seller.
So in this case, we were seller buyers.
We are sellers, so we'll make a loss.
So for us, it is a.
Loss.
Is it clear?
Yeah.
So when you are selling options, there can be a huge loss. When you are selling option, your maximum profit is your selling price, that is 59 rupees. But your loss can be 141, can be 241, can be 541, anything. If market goes to 9,500, yours will be 741. So when you are selling options, your loss can be unlimited. Your profit is limited.
Yeah.
Am I right?
Right.
So let us see question number 14. Buying a call has unlimited profit and limited loss.
Correct.
True or false?
True.
Correct, sir. True.
We have already done that. It is true, right?
Yeah.
Selling a call has limited profit and unlimited loss potential.
True.
This is all. This also we have done. So this is also true. All of you agree? Or there are some disagreements? No.
No, sir. No.
Now the question is, why will a rational mind sell a call?
That is the question which I am going to ask. Now, buying options means unlimited profit and limited loss, right?
Yeah.
And selling options means limited profit and unlimited loss. So what we should be doing, as he rightly said, what we should be doing, if this is the equation and we know this equation is true.
Yeah, but I can't buy an option if there is nobody selling it, right?
No, let us assume there is a sufficiently big market and trades are available. Obviously, if nobody is selling, I cannot buy, right? But if let us say somebody is selling, will you buy?
I will buy if I feel the market is in the direction of what I think will go. I will not blindly buy.
So this equation is true. Buying options means unlimited profit, limited loss. Selling means limited profit, unlimited loss. So any logical person, what he will do? He will only buy options,
Correct, sir.
right? And he will always make money.
No, he will have a limited loss. He will not always make money. He will make a limited loss.
But then it is a limited loss. Why can't I continue like doing that? Someday I will make unlimited money.
But probability is lesser. That is the problem.
Exactly. So if you buy a lottery ticket worth 500 rupees, it's a limited loss. You can win even 2 crore rupees.
Yeah.
So you keep on doing that for 30 years. Chances are like you may spend 20 lakhs in buying lotteries and you may win 2 crores or not. Nobody can answer that, right? So what is the probability of you winning a lottery ticket?
1 in 10 million.
500 is a limited loss, right? If I keep on doing that for let us say 1 lakh times
So 5
in my
crores.
lifetime, right? Will the probability of winning increase?
No.
Right? Although I am having a limited loss and my profit can be unlimited. Right?
Yeah. Your probability is winning is higher if you buy in the same this thing 1 lakh ticket. Then your probability is more. But if you buy 1 lakh ticket on a repeated basis, your probability remains the same.
No, you can buy, you see, if there is one prize and there are 10 lakh tickets, you can buy 9 lakh tickets and still lose. Right? Because the lottery maker is not making loss. Lottery seller is not making loss. Ultimately, he is giving a portion of money what he has taken as a lottery prize.
Yeah.
Right?
Correct.
You can buy all the tickets. There is a 100% probability you will win. But whether that will be worth?
Yeah.
All the tickets will cost you 10 crore rupees. You will win a prize of 2 crore rupees.
Yeah.
That is 100% probability.
True.
But that doesn't make sense. Right? So buying options, again, you see, if you go to the previous slide, here we have a very dangerous word which is talking about potential,
Yeah.
right? Potentials are rarely achieved.
Mm.
Potentials are rarely achieved, right? So if out of all of us, can we say anybody who has achieved his potential in life? I am not talking about philosophy.
Mm.
Potential real. If you ask Sachin Tendulkar, he will say my potential was to hit 1,000 centuries. I was able to hit only 100,
Mm.
and 27 times I was out within 90 and 100.
Mm.
If you see, India has a potential of producing maybe 5 lakh Virat Kohlis, but we have produced only one. So potentials are rarely achieved, right? It is a theoretical concept.
Yeah.
Potentially, I am also equal to Mukesh Ambani, but I am not even 1 crore of him, right? So potentials are rarely achieved. Whatever we have learned, that is in concept, in theory, yes, that is possible. But that what is the probability of that happening? We need to see that.
Yeah.
That is why we say in selling options, you will have limited profit, unlimited loss, but this limited profit probability is 99.9%.
Correct,
And
sir.
you need to do something to avoid this unlimited loss.
Yeah.
And that is where we say consistent returns in buying and selling of options. We need to avoid this unlimited loss through proper usage of strategies. That is why we require strategies,
Mm.
Exactly.
right? We will make a limited profit, but we will avoid this unlimited loss.
Mm.
इसीलिए
That's
आपके घर पे आए हैं.
इसके लिए हम मेरे तरफ से आए. Okay, very good. Right? So that is the whole game. Otherwise, you see, the equation is very simple. Then we don't require 2 days. In half an hour, we understood that okay, buying option makes sense. But I don't know, Mr. Rao and Doctor, you have done trading, right?
Yeah,
Have you
trading,
made
yes,
money
sir.
by buying options?
Mm.
How many
No,
times you have
sir.
made money by buying options?
No, sir.
You haven't made money by buying options, right?
Yeah,
So
yeah.
most of us do not make money buying options. Why? Because we are our own biggest enemy.
Mm.
We will never allow the profit to become unlimited. Suppose you have
Correct,
purchased
sir.
an option at 100 rupees. As soon as it
Mm.
touches 110, you will square it off.
Yeah, correct, sir.
Yeah.
90% of people will square off the profit at 10 rupees.
I contest. I do the same thing.
Right? So how will it become unlimited profit?
Nobody knows, sir.
Right?
First
At
book the profit.
But loss
110, all of
we
us
won't
will
square up,
cross.
sir. If it goes to zero, it will naturally square up.
It will automatically scare off.
Yeah.
That is
Till
okay.
then, we will
But
wait.
that okay, someday God will be happy with me. I have read Hanuman Chalisa 24 times. So today the option price will go up.
Mm.
Right? At 115, the balance 10% will also scare it off.
Mm.
So where is the unlimited profit? We never allow our profit to become unlimited because we are very satisfied people. We don't want more profit.
Mm.
We don't big loss.
I know the thinking will be I put in 100. I've already made 15 rupees profit in 2 days. That annualized 4,000%, something other. I feel so thrilled. Right?
But what about the previous loss?
I know.
So, so that is the issue. So ultimately, I need to have a system where I can make this limited profit every time I trade.
Mm.
Right? It is limited, I know, but even this limited profit is worth it or not, we will see in next slide.
Mm. Okay.
Saying limited profit, that cannot be a bank fixed deposit return. Then it doesn't make any sense to go to options trading.
Correct.
Right? It has to be much more than that. So
Correct.
how how much profit we want to make? When I ask profit expectations, people say 200%, 100%, but we need to rationalize it, right? So what is the profit we want to make? So we say rupees 5 profit in Nifty option selling implies 1% profit. So let me try to explain this. Suppose you have sold an option in 100 rupees and you have purchased it back in 95 rupees. Profit?
5%. 5%.
5%, right? Because you sold it in 100 rupees, you purchased it in 95 rupees.
Yeah.
I am saying here 5 profit means 1% profit. Is this a misprint or what?
No, what is the investment margin required based on that you are implying?
Exactly, right? So ultimately, you are making 5 rupees for selling an option worth 100 rupees. You do not require 100 rupees, you require 37,000 rupees. It will block a margin of 37 to 40,000 rupees. So I have made 5 rupees, 5 into 75, 375 rupees on an investment of 37,000 rupees, which is just 1%.
Okay.
Right? So I will see what kind of money is blocked in doing that transaction. From there, I will calculate what is my percentage profit. Even if I am selling an option worth 50 rupees, 45 rupees, I have made 5 rupees. That is not 10% profit because I have sold it at 50 and made 5 rupees on 50. Even for selling an option worth 50 rupees, you need to block 37, 40,000 rupees. So irrespective of what is the price you are selling, the thumb rule we say 5 rupees profit in option selling means 1% profit.
Oh, right.
Right?
It's shortcut.
Guided by these things that okay, we sold in 50 rupees and we purchased in 40 rupees, so we have made 20% profit. Nothing like that. Even for selling 50 rupees worth of option, you require 40,000 rupees. So I will take denominator as what is my investment, not what is the transaction value, right?
Correct.
The investment is 40,000 rupees. So I will consider what money I am making on 40,000 rupees. So one assumption is that 5 rupees is, that is a very clear cut thumb rule. 5 rupees is 1%. So if I want to make 5% per month, then how much money I should make?
25 rupees.
Yes, if 5 rupees is 1%, 5 rupees, then 5% is 5 into 5, that is 25 rupees. If I am able to make 25 rupees per lot every month, I am making 5% return every month.
You are saying it cost me 37,000 rupees. So if I make a profit of 5 rupees, I make 375. 375 divided by 37,000.
Yeah, is roughly 1%.
Yeah, roughly just above 1% here.
Yeah. No, there will be some transaction cost, brokerage,
Yeah.
and all that we have included here, right? Very perfect understanding.
Okay.
So to make 5%, I need to make 25 rupees per lot. 25 rupees will be 3750. 25 into 75.
How did you arrive at the margin required to sell one lot of 37,000?
That is the standard margin. You see, that is fixed by exchange. So 37,000 may be slightly old because market has gone up. So now they may be requiring 38,000 or 39,000. You can check it on any margin you see with your broker also.
Okay.
Right? That is the standard margin which exchange will block for doing these kind of transactions.
That is
So I'm saying
or something like that.
there, but overall, if 5 rupees is not 1%, maybe 5 rupees 20 paisa will become 1%.
That's fine. That's
Right?
irrelevant.
So 25 rupees per lot I need to make, and this is the now 5% per month means 60% per year. So show me a business, I will leave everything and I will run behind that business, which gives me even 50%, even 40% per year. Right there, you see now a lot of quarter end balance sheets were published in newspaper last month after the second quarter, right? Most of the companies, Mr. Adiga will tell whether I am right or wrong. most of the companies struggle to give 5% per quarter.
That's a
On the
lot.
capital
5% a quarter is lot. They're struggling.
Is one of the best companies which will declare that kind of a result.
Yeah.
Right. So here we are talking about something like 5% per month. I'm saying even if I'm right for 8 months and 4 months I do not make any money, I do not lose anything, I'm still 40% plus.
Mm.
Right. So
Correct.
even if it is a limited profit, it is substantially good if we compare it with some business. But only problem is when we come to stock markets, we think it is a ATM machine and I will quickly make a lot of money, which is a recipe for failure. And ultimately, you need that kind of traders in the market. How will you otherwise make money? It's a zero-sum game. Somebody has to lose for you to make money.
Correct.
Yes. So you would not like to train everybody in this, right? Otherwise, you will stop making money. Okay. And
Agree.
what kind of... Okay. Now let us say I'm trying to show you something which should sink in very well. Now, what is simple interest formula? Everybody knows, thanks to some movie where the hero was telling P into R into T divided by 100 is the interest. There was some movie, Varun Dhawan. Right? Compound interest formula, obviously we know principal into 1 plus return percent raised to power time. And what is most important in this? In exponential, we have time. Even my return is 3% or 4% or 5%, as long as it is positive, it is not that important. The important is time. If time from 2 becomes 4, everything gets scared. Time is what matters most, right, in this formula. And we always keep on running behind percentage return without giving time. Everybody wants to become rich. That is possible. But everybody wants to become rich very quickly. That is not possible. Right? So even if Infosys shares, if you see somebody who has purchased in 1991, now if we are now 27, 28 years after that, it has become worth 5 crores or 6 crores or whatever. But it has taken 27 years.
Yeah.
Right? So we do not want to give even 27 days to a trade. And we want, okay, it should give me huge money. That is the biggest issue.
Unknown variable also, right? Like Infosys has done well in 27 years, but there are many companies which have folded and gone in the period.
Exactly. That is also there. Law of averages will always catch you up. And secondly, whatever was the investment in 1991, even if you back calculate for 27 years, it is a CAGR of 15% only. Right? Mr. Diga, you are one of the investors. You can back calculate for 27 years compound interest. It will be a CAGR of 15 to 16%.
Yeah.
Right? So that in our website, I don't know whether you have seen that blog. There is a blog. Can you repeat the kind of Infosys performance? Infosys cannot repeat that, but we definitely can repeat that.
Sure, sir. Correct.
Right? So time is what matters most. We must be ready to spend some time in number of years, right? Plus time, what it will do. Suppose you invest 10 lakh rupees and you do not make 5% per month, you make 2.5% per month. That is 50% of what over glorified scene I am showing you. Right? Only 50% of time we are successful, let us say. Only 50% is our success rate. We earn only 30%, not 60% annual returns. Now, if I am compounding it annually, not monthly, what will the 10 lakh become? One time investment of 10 lakhs, it will become 37 lakhs in 5 years. 1.38 in 10 years. 5 crores in 15 years. 19 crores in 20 years. Right? So if I'm somebody, let us say 35, I have another 40 years of active life, right? So in 25 years, it will become 70. And any guesses what will it become in 30 years?
200.
Huh?
200, 300 crores.
262 crores. So we need to give time. We need to give time and we need to give consistency to our returns. That is more important. Right? And this I am saying in case we are only successful 50% of times, part A. Part B, we are not doing any, and we are doing only monthly options. But tomorrow when we will be discussing strategies, I will be telling you methods wherein the same capital is used for long-term capital appreciation plus monthly returns. Is shown on the screen will multiply manifold.
Basically, I mean, this is an example where somebody from Citibank came and offered, saying that, your Infosys stock can be there in a demat account, earning the capital appreciation. We will do such a way that we'll get you a monthly return. So, anything Citibank proposes, we dispose immediately because it's very scary.
No, you can propose after completing tomorrow's session, you can propose such a thing to Citibank.
Super, sir. They can charge.
Not worry about it. Yeah.
Excellent.
Right. But my only submission here is that we should have a focus for at least next 5-6 years.
Yeah.
And all of you are pretty rich. I know that. So 10 lakhs is nothing for you. So start with 4-5 lakhs, then slowly increase.
Yeah.
Make it an investment of 25-30 lakhs, and you see the returns will be so much that you need not do anything else. I am not a fool that I have left a government job. Right? There must be something in it, right? Even limited returns are pretty good in case we know how we can take these returns.
Sir, one question here.
All we are looking for is above risk-free return with a low probability of failure. That's all.
You see, I am always fond of a book. If you have heard, I will send you a link also.
Sure, sir.
Right, before starting your trading, I will definitely recommend to read that book.
Which book? Sorry, I missed the name.
It is. I will send you the link on email ID. Foolish by randomness.
Fooled by randomness. I have that. Yeah.
Fooled by randomness. Yeah. You have heard of that book?
Yeah. Nassim
Taleb. Right.
Yeah.
So we must go through that book before doing any stock market trading.
Yeah.
Yeah. Please send the link, sir.
I will send you. I am not going to send you the book, but you can just.
Yeah, that is fine.
Okay.
Sir, wonder.
Yeah.
Sir?
Please go. Yeah.
Sir, wonder if you are investing some small amount, then we will get this kind of it. Is it applicable after 100 crores also, 50 crores also?
You see, as far as Indian markets are concerned, as long as it is 100 to 200 crore, it will easily absorb, and there is no issue. But if you are a big hedge fund investing thousands of crores, then maybe you need to diversify the funds. You need to see use different instruments available in the market. The market will not even recognize that something is happening.
Okay.
Yeah. Right. So you are a really rich man, that way.
Not like that, sir. I thought of this one. After this,
okay.
If mutual funds are starting this strategy, they can earn still more, no? They are not able to put so much of money in this strategy. That is the thing, I think.
Right. Okay. So we will see. Now we will take a break here. What, 10 minutes is more than sufficient? You can have your cup of tea, bio break. What I will be doing now, we are finishing this live session on YouTube also, and I will be sending you a new link. So you need to connect with that new link, which will be coming to you right in 5 minutes from now. But we will start 10 minutes by your own watches. 10 minutes from now, we will start again, and then we will take another roughly 90 minutes, and then after that, we'll have half an hour break for lunch.
Okay.
So, right?
Okay. Thank you.
Right? I will be sending a new link. This link will go away now, right?